Hey, it's Steve Ryder with Keller Williams and Ryder Realty Group here today with more real estate conversations.
And this is Genna Lott with Supreme Lending, taking the emotion out, and let's talk about some logical solutions in today's market.
I like it. Let's do it. So, Genna, I have a lot of people ask me questions all the time about interest rates and how that affects buying a home and closing costs and all the questions that most of your typical consumers buying a home don't know, and that's what we're here for as a realtor, as a loan officer. So, but I have a lot of people ask me. As a matter of fact, my neighbor here asked me the other day about the buy down, the rate buy down. So, can you explain a little bit how that works and how that will affect you short term, long term when buying a house when the rates are so high?
That is a fantastic question. So there's two main different types of buy downs that a lender's looking at. One of which has been around for a really long time. Another option that comes around typically in a higher interest rate environment like we're in today. So your first option is your standard buy down. And that is where you are essentially paying the difference between the current market rate and the rate that you close in an additional closing cost. Okay.
So it gets added to your closing costs.
It gets added to your closing
costs. You don't have to come out of pocket for that.
Well, you are in your closing costs.
Eventually, but you don't have to write a check for it at that time.
Right. You're not writing the check at the time that you lock in the interest rate. You're having that conversation with your lender.
Right.
But the big key is that buy down impacts your rate over the course of the full 30-year mortgage. Okay. So it can cost a lot of money to make a little difference because you're impacting that year over a 30-year mortgage. And where that can become a problem in a higher interest rate environment is your average consumer is going to be in your home or in that mortgage for, on average, 3 to 5 years. And the reality is we know that if rates plummet, that timeline is going to shorten for our current people that are buying right now.
Right.
So let's say, for example, that you're buying a $400,000 home and the interest rate is at 7.5% and you want to buy down that rate to 7%. The way that I explain that to a buyer is I explain that you are investing in yourself for future savings.
Okay.
So
I like that.
Yeah. So I'm investing in my closing costs to save in the future. It becomes a math problem. Again, I love that numbers take out the emotion because it becomes a formula of how many months of me making that reduced payment until I've made my investment back. Right. If you go to sell or refinance prior to that break-even point, then your buyer lost money in buying down that interest rate. Okay.
Yep.
But for every month after that break-even point, let's say that buying down the rate saves you $75 per month. And once you pass that break-even point, now every month you're profiting $75 per month after you pass that break-even point.
Right.
But if you go to sell or refinance prior to that break-even point, then you have lost money in buying down the rate. And that's where, as a lender, you're walking a fine line of a lot of people, they're looking at that rate figure and they want it lower, but they don't understand the cause and effect of the decisions that they make sometimes. And that's where I'm here to help guide them of, hey, yes, you're investing in yourself for future savings, but what's that really going to look like long term? Right. So that's where in a higher rate environment, what we call a temporary buy down really comes into play. And what a temporary buy down is it really works where you're using seller paid closing costs that are negotiated in the contract to essentially subsidize the current payment. So your buyer is, again, let's go back to the original scenario. Your buyer is in a 7.5% interest rate. Okay. And on a 30-year fixed rate mortgage. And for the same amount of money, and I'd have to do the math, this is more concept understanding, but for the same amount of money that they can buy down the rate for half a point, they can do a 3-year temporary buy down and reduce the rate for a temporary period for a much bigger impact. And the cool thing about it that I'm about to talk you through is that there's no risk of money lost at the end of the day. Okay. So
that's big.
It's big. So essentially, that seller contributes towards closing costs and negotiation. So you as the agent, you would as you're representing your buyer, you're going to work towards negotiating for closing costs being collected by the seller. That money that's collected from the seller in closing costs, the buyer would have their choice. Do you want that to go towards your actual closing costs, or do you want a portion or all of it to go towards a temporary buy down option?
Right.
If they choose the buy down option, that money goes into a side escrow account, just like taxes and insurance does.
Mm-hmm.
And it essentially makes the difference of the mortgage payment for the buyer every month. So they're still in a fixed rate mortgage. That rate isn't going to increase. It's not an ARM loan, anything like that.
Right.
But it's making a temporary difference of that payment. So let's say, for example, that a buyer negotiates for a full 3-year buy down, which is the most that you can do. Mm-hmm. That would mean that first year, the interest rate is reduced by a full 3%. So instead of reducing from 7.5 to 7, now we're looking at going from 7.5 to 4.5%.
Okay.
Much more significant impact in their
very much significant
in their interest rate.
Right.
The second year, that rate goes to 5.5%. The third year, 6.5%. Then that fourth year, after the 3-year temporary buy down is up, is when they're paying their actual fixed rate mortgage payment.
Okay.
But the cool part of that is, let's say, for example, that rates drop in a year and a half.
Okay.
And that client really wants to utilize that current market and refinance into a lower interest rate. Whatever money is left over in that escrow account, it doesn't just disappear.
Right.
It gets applied towards the principal balance of the loan.
Ah, okay. So if there's five grand left in there, it goes $5,000 towards your principal balance.
Yep, exactly.
Okay.
So regardless
like
of what happens in the market, yeah. And regardless of what happens in the market, whether you wait out the full year of temporary buy down or whether you refinance or sell prior to that timeline being up of how many years you end up negotiating, you're not running a risk of money lost at the end of the day. Because either you're impacting your payment right now or whatever's not being used gets applied towards your principal balance.
I like it.
Unlike paying points and buying down the rate in the old school way,
right?
That would be potential money lost if they haven't recouped that money back.
Isn't it funny how we're talking about old school when we're talking about buying points?
I know it.
Right?
I know it. Well, and the reality is just helping consumers understand the pros and cons of these decisions that they're making.
And also making sure they understand that we're doing this for their benefit, not for our benefit, not for your benefit, not for the loan company's benefit. This is to help them save money over time. And understand that, the more money we can keep in their pocket, the more they can spend on their house.
And that's actually a great point because no lender charges any fees in the buy downs.
Okay.
So regardless of who is offering that program, there's no fees associated with it. A lot of people will come to me and ask, what's the catch? It sounds too good to be true.
Right.
And the catch is just that in a high interest rate market, this gives us a competitive edge.
Yeah.
If you as a lender offer temporary buy downs, then you're able to provide your client with additional value and hopefully be able to retain more business.
And I think the biggest thing for us as a realtor is to I rely on you a lot for explaining things like that. But I think for us, it's hard for us to explain that to the consumer and explain that to our clients because we don't completely understand it because it's not our place to do that. But I think as realtors, it would be good for realtors to understand a little bit of how that works so we can explain it to the point to where we can get them to talk to you where you can really narrow it down and really nail it down like you just did.
Right.
So great.
Right.
Thanks.
Yeah.